Thinking about buying a house or investing in real estate? You've probably heard it's a safe bet, a surefire way to build wealth. But is the housing market really as safe as everyone says? In this video, we'll explore why people see housing as a safe investment, the risks you might not hear about, and how to make smarter decisions whether you're buying a home or investing in property. By the end, you'll have a clear picture of whether the housing market is right for you. Let's dive in. To understand why so many people trust the housing market, let's start with the reasons it's considered safe. 1. Historical appreciation. First, real estate has a strong track record. According to data from the National Association of Realtors, the median home price in the U.S. has risen from about $25,000 in 1970 to over $400,000 in 2025. That's an average annual growth rate of about 5 to 6%, outpacing inflation most years. Unlike stocks, which can swing wildly, home prices tend to grow steadily over time, making them feel predictable. 2. Tangible asset. Next, real estate is a tangible asset. You can see it, touch it, live in it. Unlike a stock or crypto token, a house isn't just a number on a screen. It's a physical property with intrinsic value. Even in tough times, you still have a place to live or rent out. 3. Leverage. Real estate also allows you to use leverage, borrowing money to buy an asset. With a mortgage, you might put down 20% and control a property worth 5 times that amount. If the property's value rises, your return on investment is amplified. For example, a $400,000 home that appreciates 5% in a year gains $20,000 in value. If you only put down $80,000, that's a 25% return on your money. 4. Income potential. Finally, real estate can generate income. Rental properties provide monthly cash flow, and in 2025, with demand for rentals high in many cities, this is a big draw for investors. Plus, tax benefits like mortgage interest deductions or depreciation can sweeten the deal. So, with all these perks, it's no wonder people see real estate as a safe bet. But here's the thing, no investment is risk-free. Let's talk about the other side of the coin. While the housing market has its strengths, there are serious risks that can catch investors off guard. Let's break them down. 1. Market volatility. First, the idea that real estate always goes up is a myth. Home prices can and do fall. Look at the 2008 financial crisis. U.S. home prices dropped by 20 to 40% in many areas, leaving millions of homeowners underwater, owing more than their homes were worth. Even in 2022, rising interest rates cooled markets, and some cities saw price declines of 5 to 10%. In 2025, with interest rates hovering around 6 to 7% and inflation still a concern, price growth in some regions has slowed or reversed. 2. Illiquidity. Unlike stocks, which you can sell in seconds, real estate is illiquid. Selling a house can take months, and in a down market, you might not get the price you want or any buyers at all. If you need cash fast, a property isn't like an ATM. 3. High costs. Owning a home or investment property comes with hefty costs. Beyond the mortgage, you've got property taxes, insurance, maintenance, and unexpected repairs. For rental properties, vacancies or bad tenants can eat into your profits. According to a 2024 study by Zillow, the average homeowner spends about $14,000 a year on maintenance and taxes alone. That's not pocket change. 4. Interest rate risk. Interest rates are a huge factor. In 2020, mortgage rates were as low as 2.5%, making borrowing cheap. By 2025, rates are closer to 6 to 7%, increasing monthly payments and reducing affordability. For example, a $400,000 mortgage at 3% has a monthly payment of about $1,686. At 7%, that jumps to $2,661, a 58% increase. Higher rates also cool demand, which can stall price growth. 5. Local market dependence. Real estate is hyperlocal. A booming national market doesn't mean your city or neighborhood is thriving. For instance, in 2025, cities like Austin and Phoenix, which saw huge price spikes in 2020 to 2022, are cooling off, while smaller markets like Raleigh or Boise are holding steady. If you invest in the wrong area, you could face flat or declining values. 6. Economic and demographic shifts. Finally, broader trends can shake the market. Remote work has changed where people want to live, boosting demand in suburbs but softening urban cores. Aging populations in some regions mean fewer buyers in the future. And if a recession hits, job losses could lead to more foreclosures, driving prices down. These risks show that real estate isn't a guaranteed win. But does that mean it's a bad investment? Not necessarily. It depends on your strategy and circumstances. Let's look at how to evaluate if it's safe for you. To decide if the housing market is a safe investment, you need to weigh your goals, finances, and the market you're in. Here are the key factors to consider. 1. Your financial situation. Real estate is only safe if you can afford it. A good rule of thumb is the 28-36 rule. Your housing costs, mortgage, taxes, insurance shouldn't exceed 28% of your gross monthly income, and total debt payments shouldn't exceed 36%. For example, if you earn $5,000 a month, your housing costs should stay under $1,400. Also, have an emergency fund, 3 to 6 months of expenses, to cover unexpected repairs or vacancies. 2. Time horizon. Real estate is a long-term investment. Historically, holding a property for 7 to 10 years or more increases your chances of seeing appreciation and weathering market dips. If you're planning to flip a house or move in a couple of years, you're taking on more risk, especially in a volatile market. 3. Local market research. Do your homework on the area you're eyeing. Look at job growth, population trends, and new developments. Tools like Zillow, Redfin, or the U.S. Census Bureau can provide data on price trends and demand. For example, in 2025, markets with strong job growth like Charlotte or Nashville may offer better stability than oversaturated markets like San Francisco. 4. Diversification. Don't put all your eggs in one basket. If your entire net worth is tied to a single property, you're exposed to local market risks. Balance real estate with other investments like stocks or bonds to spread your risk. 5. Rental potential. If you're investing, calculate the cap rate, the net income a property generates divided by its purchase price. For example, a $300,000 property with $18,000 in annual rent after expenses has a 6% cap rate. Compare this to local averages to see if it's a good deal. Also, check vacancy rates and landlord laws in your area. 6. Interest rate outlook. In 2025, rates are high but expected to stabilize or slightly decline if inflation cools. If you're buying, consider locking in a fixed-rate mortgage to protect against future hikes. If rates drop, you could refinance later. By focusing on these factors, you can better gauge if real estate fits your financial plan. But what about strategies to make it safer? Let's talk about that next. Even with risks, you can make real estate a safer investment with the right approach. Here are 5 strategies to protect yourself. 1. Buy below your means. Don't max out your budget. A cheaper home gives you wiggle room for repairs, rate hikes, or market dips. Aim for a property you can comfortably afford even if your income drops slightly. 2. Get a thorough inspection. Before buying, hire a qualified home inspector to check for issues like foundation problems or outdated wiring. A $500 inspection could save you tens of thousands in repairs. 3. Diversify your real estate investments. Instead of one property, consider real estate investment trusts or crowdfunding platforms. These let you invest in real estate without the hassle of managing a property. In 2025, platforms like Fundrise or RealtyMogul offer low-cost ways to diversify. 4. Focus on cash flow for rentals. If you're buying to rent, prioritize cash flow over appreciation. A property that generates positive monthly income after expenses is less risky than one banking on future price gains. 5. Stay informed. Markets change fast. Follow economic indicators like interest rates, unemployment, and housing inventory. Free resources like the Federal Reserve's website or Redfin's market reports can keep you updated. These strategies can tilt the odds in your favor, but no investment is bulletproof. So, what's the verdict on the housing market in 2025? In 2025, the housing market is a mixed bag. High interest rates and affordability challenges are cooling some markets, but strong fundamentals in growing areas still offer opportunities. Anyways, that's all in this video. Hope that helps, and bye for now. We will meet next time in a new video.